If you save $2 to $4 million for retirement, you're in a financial catch-22 no one warns you about. Too wealthy for government help, but not rich enough to ignore a $500,000 long-term care bill that could wipe out your nest egg. And that traditional long-term care insurance solution everyone pushes. For families like yours, it often creates more problems than it solves. In this video, I'll show you why this squeeze exists, why traditional insurance falls short, and 5 practical strategies that actually work for people dealing with this exact dilemma. Before we dive in, just a quick note. I help clients navigate estate and long-term care strategies, but I'm not an attorney. And this video isn't legal advice. Use it to have a smarter conversation with your estate planning lawyer. Here's what this catch-22 actually looks like. Imagine you and your spouse have $3 million saved for retirement. You are following the 4% rule, living on about $120,000 annually from investments, plus Social Security. You feel secure, right? Now imagine one of you needs memory care for 5 years. At today's costs, around $100,000 annually, that's $500,000 gone. Suddenly, your comfortable retirement becomes a $2.5 million retirement, and your safe withdrawal rate just got cut by nearly 20%. It's like planning a cross-country road trip with a full tank of gas, only to discover there is a massive hole in the tank halfway through. And here's the kicker. To qualify for Medicaid long-term care coverage, you typically need less than $2,000 in countable assets as an individual. Your house usually doesn't count, but everything else does. IRAs, 401ks, savings, investments, everything you've worked to build. That's the squeeze. Your wealth disqualifies you from help, but the risks are too big to ignore. The insurance industry's solution is to sell you long-term care insurance. On paper, it sounds reasonable. Pay premiums now to protect against high care costs later. But for retirees in this middle zone, the numbers often don't add up. These policies can be expensive, restrictive, and surprisingly unreliable when it's time to file a claim. Think of traditional long-term care insurance like flood insurance for a house that's built on a hill. It might help in some scenarios, but it doesn't address your real vulnerabilities, and it's expensive protection for risks that might never materialize. Imagine, a healthy 65-year-old couple might pay $5,000 to $7,000 annually for meaningful coverage. Over 20 years, that's $140,000 in premiums. The policies typically provide $300,000 to $500,000 in benefits, with various restrictions on when and how you can use them. But here's the catch. Most policies have waiting periods, coverage limitations, and specific definitions of what qualifies as needing care. You might pay premiums for decades, then find out your specific situation doesn't qualify when you actually need help. It's like paying for car insurance for 20 years, then discovering in an accident that your particular type of crash isn't covered because it happened on a Tuesday during a thunderstorm. Even worse. These policies have become notorious for massive premium increases, 40 to 80% rate hikes on policies purchased just 10 years ago. For families carefully managing retirement income, this creates a terrible dilemma. Pay the increased premiums or drop coverage and lose years of premiums. If this sounds like your situation, don't wait. The longer you put this off, the fewer choices you'll have, and the more expensive those choices become. This is kind of planning we do with families who want to stay in control, not just react under pressure. If you'd like to take a closer look at your numbers, understand where you might be exposed, and start building a plan to protect your wealth and your family, just use the link below to grab a time that works for you. It's about 45 minutes and you leave with real clarity. No sales pitch, no pressure, just a conversation focused on your goals. Now, maybe you've looked into hybrid policies that combine life insurance with long-term care benefits. They are often marketed as the perfect middle ground, something you'll use either way, whether you need care or not. But hybrid policies are like those combination washer-dryer units. In theory, they do 2 things at once. But in reality, they rarely do either one well, and they cost far more than buying separate specialized units. To get meaningful coverage through a hybrid policy, you're looking at $100,000 to $200,000 in upfront premiums. For a family managing a $3 million retirement, that's a huge chunk of capital tied up in an illiquid product. Let's say you put $150,000 into a hybrid policy at age 65. If you never need care, your heirs might get $200,000 in life insurance benefits 20 years later. That's about a 1.5% annual return. Now, compare that to investing the same $150,000 in a diversified portfolio earning 6%. In 20 years, that grows to over $480,000. Even after covering potential care costs, you'd likely come out ahead. Hybrid policies are loaded with features, return of premium riders, inflation protection, but here's the issue. You lose flexibility when you need it most. If the markets drop or an unexpected expense comes up, you can't tap that capital without disrupting the policy. For financially secure families who don't want to lock up their retirement capital, this isn't financial protection. It's an expensive gamble built on your worst-case scenario. So what should you do instead? Here are 5 strategies specifically designed for families who fall into that uncomfortable space between too much for help and not enough to self-insure. Strategy number 1, the hybrid self-insurance approach. Instead of paying insurance companies, consider building your own care fund, something designed for growth, liquidity, and control. Set aside $150,000 to $250,000 in a dedicated account earmarked for future healthcare costs, but keep it invested appropriately based on your timeline and goals. This doesn't need to cover every possible scenario. The goal is to fund the first 2-3 years of care, giving you time and breathing room to make smarter decisions under pressure, not desperate ones. Think of it like a personal buffer zone. You're managing the most likely risk yourself, with the flexibility to pivot if needed. And here's the beauty of this approach. If you never need long-term care, the money stays in your family and continues working for your legacy. If you do, it's available immediately, without having to fight insurance definitions or wait for approvals. Strategy number 2, asset and legacy firewall. Reorganize your financial house so the most valuable items are in the fireproof safe. Think of it like restructuring a business to be more tax efficient and creditor protected. Same assets, smarter structure. Consider starting with your retirement accounts, which are often fully exposed in care scenarios. Strategic growth conversions, paying off a mortgage early, or repositioning assets into more favorable vehicles can reduce exposure and improve long-term tax efficiency at the same time. Your home is typically your largest non-liquid asset, and while it's often exempt from Medicare calculations, it's not always shielded from estate recovery. Some families explore options like life use deeds, downsizing into protected property, or purchasing the right to live in a child's home. These strategies are highly state-specific, so working with an elder law attorney is critical before moving forward. Life insurance can also play a role, not necessarily to fund care, but to restore what's spent. Some families use policies owned by adult children or held in irrevocable trusts. If structured properly, this may replace the dollars used for care with tax-efficient wealth passed to the next generation. It's like installing a financial backup generator. Quiet until you need it, but crucial when you do. All of this takes proactive structuring and should always be reviewed in coordination with your legal and estate planning team. But if done early enough, it helps you appear financially modest on paper without giving up real access or flexibility. Strategy number 3, the family care compact. Rather than paying strangers $8,000 to $12,000 monthly for care, some families look at ways to compensate adult children who step in to help. This keeps money in your family while providing personalized care from people who actually love you. Here's how it works. If professional home care costs $8,000 monthly in your area, you could pay your adult children similar rates to coordinate and provide care services. It's like having your children manage your rental property for a fee. The job gets done professionally, but profits stay in the family. Some families even create prepaid caregiver agreements, where a lump sum is paid upfront for future care. This can be a powerful way to spend down assets quickly and cleanly in a Medicaid-compliant way, but must be actuarially calculated and carefully structured with qualified legal counsel. The key is to work closely with your professional team, document everything properly, pay fair market rates, and treat it like the legitimate business arrangement it is. This can significantly reduce total care costs, while keeping your family financially intact. Even with family pitching in, care dollars still need stretching. Strategy number 4, geographic care arbitrage. Care costs vary dramatically by location. We are talking about differences that could save you $50,000 or more annually. The same quality memory care that costs $120,000 annually in expensive metro areas might cost $70,000 in other regions with excellent facilities. Think of it like choosing between a luxury hotel in Manhattan versus the same hotel chain in a beautiful smaller city. Same quality, dramatically different price. Plan this in advance. Research high-quality care options in lower-cost areas where you might actually enjoy living. Consider pre-registering with 2 out-of-state communities now so wait lists don't trap you later. Structure your finances so relocating for care becomes an attractive option rather than a desperate last resort. This single strategy could stretch your care dollars by 40 to 50%, making the difference between depleting retirement savings and preserving wealth for your family. Strategy number 5, Medicaid Bridge Plan. Here's something most people don't realize. You don't have to stay poor forever to benefit from Medicaid. But the system is built for early planners, not last-minute scramblers. Medicaid has a 5-year look-back period, which means the clock starts ticking long before you actually apply. Every year you wait narrows your runway and limits your flexibility. The real goal is to legally position yourself to qualify for benefits when the time comes, while preserving as much of your wealth as possible for your spouse and your family. This strategy connects the dots between everything we've talked about: repositioning assets, compensating family caregivers, even relocating to lower-cost areas. Together, they become a comprehensive framework to bridge the gap between private pay costs and Medicaid eligibility. It often involves tools like irrevocable trust, strategic gifting, caregiver contracts, and spousal asset protections. But the details matter, and the timing matters even more. This isn't something to patch together on your own. It's the kind of planning that works best when your advisor and attorney are on the same page. Think of it like tax planning. You are not avoiding your responsibilities. You are aligning your plan with the rules so your family keeps more of what you've built. And when structured correctly, this approach can help a married couple preserve their home, keep a healthy amount of savings, and still qualify for care support without blowing up their retirement. Here's the bottom line. If you've built up serious retirement savings but still feel exposed, you are in a uniquely tough position. You are too well off to qualify for help, but not wealthy enough to self-insure without consequences. And while traditional insurance is often presented as the default answer, it's rarely built for the middle zone you are in. What works instead is a custom approach, layered, flexible, and designed around your actual goals. The good news? You have options, but many of them require action before you need care. Timing matters, whether you are repositioning assets, setting up legal protections, or building an internal care fund. When it comes to long-term care, early planning puts you in control. Waiting puts your legacy at risk. And if you are assuming Medicare will cover long-term care, you could be in for a 6-figure surprise. Most retirees are, and it's one of the biggest threats to your legacy. Watch this video to see how healthcare costs really play out in retirement and what you can do now to stay protected.